Hello everyone and welcome. Today we are going to talk about managing pricing. Okay, so pricing, as we all know, is one of the very important P's in this 4 P's of marketing that we talk about. So what is the importance of this pricing as within the 4 P's framework? Is that the pricing, first of all, the price obviously has a direct relation to the profitability of your product, of your brand, right? So that's the first thing. And the second very important thing is the price. I mean, the pricing of the product is very important in relation to the positioning of the product, right? So how the brand is positioning is typically reflected in the way the brand is priced. Yeah. I often talk about this example of assuming, let's say, US Polo Association, a brand I'm sure all of you know, is trying to launch a new blazer in the market. Okay, a blazer, let's talk a formal blazer or even an informal blazer. Now, what is the information that this brand manager needs on his desk if he wants to price this product, right? So that is really the framework that we are going to learn today. If we want to do a step-by-step method, a step-by-step process to decide the pricing of the product. So the first and foremost very important step is, what is your objective of pricing? So what is the objective of pricing? So there are several objectives to pricing. We talk about maximizing short-term profits. Okay, so somebody might say that, okay, profits are very important to me and I want to make short-term profits. The other term that we often use is something called as market penetration. So what is market penetration? It's basically driving, the market share rather than going after profits. Okay, a strategy that we saw Jio adopt in the early days of its launch. They were not really running after money at that point of time. What did they want to do? They wanted to attract subscribers. So in that could be another pricing objective. Okay, another strategy. So what is market skimming? Is initially launching the product high and then gradually reducing the price over the time, because you know that many people are willing to pay a premium for buying that product early. To give an example, iPhone, for example, every time a new iPhone is launched, the iPhone 16, iPhone 17, you might have noticed that the price is typically very high. And then when the next model is about to come, the prices sort of start falling a little bit. So that is a strategy that many companies use. I think even in the OLED TVs, you saw that the prices were extremely high, curved OLED TVs, etc. at the initial stage of launch. And the reason for that was they were using something that we all called market skimming now. And the last one is price quality leadership. So quality leadership, what does it mean? It basically means that your brand is you know that your brand is a premium brand. Okay, and therefore you are typically at a premium with reference to some of the other competitor brands, right? Gillette, for example, the Mark III, the Mark V, all these ranges, they know that they are market leaders in the shaving the men shaving for men product category, right? So their products are typically at a premium with reference to competition. So the first thing, like I said, is determining the objective behind pricing. The next thing is determining demand. Okay, so you can't really price unless you know the demand to price relationship. So we use, I'm sure in economics also you must have learned terms like elastic demand and inelastic demand. So very important that the marketing manager, the brand manager, or whoever it is, he understands the relationship that price has with reference to demand. Okay, let's assume that you are the brand manager for a brand like Surf Excel or Ariel, or we were talking Raymond, whatever the brand is. If you are going to be managing the price of the product. Another thing about pricing is, for example, even home loans and car loans. And what is the pricing there? In a loan product, what is the price? The price is the rate of interest, right? So the rate of interest is the price in a loan kind of a product. So again, there, what you have to do is you will have to decide the pricing and keeping well in mind what kind of relationship it has with the demand. Okay, it is very very important that the pricing decisions are based on what kind of relationship it has with demand. The next is estimating cost. So we cannot do the pricing without knowing the cost, right? So either if you're manufacturing it on your own, it's your own factory which is manufacturing this blazer that we spoke about, or you're getting it manufactured from somewhere else. Definitely one thing that you need on your desk to make a pricing decision is the costing sheet. Okay, in costing, as you all know, you have something that we call the fixed costs, A. You have the variable cost, and then based on this too, you have something that is called the total cost, right? So the fixed cost plus variable cost is equal to the total cost. And what is the other thing that you need to know is what is the break-even point, right? So break-even point is a very important concept. Is the sweet spot where your costs are taking your sales, or your revenue that you're bringing is at least taking care of your cost, and therefore at that point you are not making any profit or you're not making any losses. So that's a very important point that as a marketer you need to know to make pricing decisions. And I also tell students a very important thing, that is that it is only about that point that the company can afford to give incentives to whoever it is, whether it's the distribution channel, whether it is the salespeople. So really speaking, that point has a very important meaning in the context of pricing. Moving forward, after doing the objectives, demand and costing, the next thing that you need to do is analyzing the competitors' costs, right? So very important to know competitors' costs. You can't do pricing in isolation, okay? If you do pricing in isolation, you have what can I say? You will either end up pricing the product too low, or you might end up pricing the product too high. And if you're pricing the product too low, a low price product also has poor quality image, so that's another thing that you will need to fight about. Okay, so the other thing that you need to really understand is competitive pricing. So what typically people do, or what I recommend students do, is that you can see what are the price range of the products in the competitive category, and then finally decide as to this is the price point that I want to price my product. And it could be, you could say that, okay, if these are the various brands, this is the brand where I feel this is the price that I deserve. So if XYZ brand is priced at this level, I am sure I can demand 10% more premium than that. And these kind of decisions can be part of the pricing. Very important that you cannot price in isolation, and understanding competitive pricing is very important part of that. And then obviously, how your product, what are the features of your product, how does it compare to competition, what is it that you're giving extra when compared to competition. If you're talking about products like loans, if you're talking products like credit cards, fair enough, my credit card is at a price premium as compared to other credit cards, and that is because I offer this ABCD features more than competitors, right? So that is another very important aspect that you need to consider. Then selecting the pricing method, right? So what are the different pricing methods available to the market here? Now, this is another very important thing that you need to do before you. So what is the first very simple back of the envelope type of calculation that you can do? One method is typically called as the markup method. So what is markup method? Okay, I have manufactured the product, the cost of the product is 100 rupees. Okay, let's assume that. And markup pricing simply said that, okay, I'll add 15 rupees profit to me, and 115 becomes my product price, right? So a very simple method, okay. What are the drawbacks for that? We already discussed that. Something that we called the target return on investment. So, a business owner, somebody at a senior level can say, oh, if I want to be in this business, then I need to minimum achieve 24% return on investment, right? So one method of doing pricing is to benchmark it with some sort of targeted return on investment. And finally, there is something called as value pricing, right? So economic value pricing, that is the most important form of pricing. So what is the value that I bring on the table? Are people willing to pay? A very simple example, I will not be able to spend much time on it, but we discussed is for example, if a normal tractor cost let's say 1 lakh rupees, it is just 1 lakh rupees is just an example. So if a normal tractor costs 1 lakh rupees, I am willing to pay 1,15,000 rupees for a Mahindra tractor. Why am I willing to pay 15,000 rupees extra? Is because I know I trust the brand Mahindra. I trust their after sales service. I trust their warranties. I trust that the product will work reliably, efficiently, it has quality, etc., etc. So value pricing is a very important concept, and that's another thing that marketers can use in terms of their pricing strategy. So after selecting the pricing method, then the last step obviously is setting the final price. So this is the broad, concept of pricing. But definitely read more about it and learn about it as you prepare. Thank you so much.